All right, for his outlook on oil and gas, we're joined by Carl Larry, Director of Oil and Gas with Frost and Sullivan. Carl, good to have you on the show. Thanks for joining us again.
Thank you for having me, Michelle.
Carl, as we've been reporting, oil is down to a 5-year low. Markets seem to tank on that. All three indices down over 1.5%. Energy-related shares really hurting. The energy sector dropping more than 3% in the hour before the close. Carl, what is going on here?
Well, we have this herd mentality right now where, every time it goes down, people are following it down. It's hard to really put a figure of where it's going to stop at. But right now, we're really thinking it's pretty undervalued. But it's really hurting a lot of companies, but more than anything, countries.
Well, it may be hurting a lot of companies and a lot of countries, but on the upside, on average, U.S. gas prices are lower. That's a good thing. They're down 62. They were 62 cents high this time last year. And some economists are saying that every cent that gas prices decline puts about $1 billion into Americans' pockets, and that you could say the U.S. is basically getting a $62 billion stimulus injection, and that U.S. consumers can now use the money that they're saving to spend on other things. What's your take on that?
I think they are. I think it builds a lot of confidence in the U.S. consumer, that's for sure. And that's a good thing. We definitely need a little boost here, and it's going to help us go into the new year with a little bit more confidence and get the economy going again. But for other countries that are really dependent on oil prices, it's kind of hurting them. But for America, we're really looking good right now.
Well, there is some fear out there among investors, Carl, that should oil fall too far, it could signal that the global economy is really in very bad shape. In your opinion, how low is too low?
I think that Brent dropping under $60 is going to be too low. I think WTI for the U.S. oil under $50 would be really too low. But it's going to be tough to see those prices get there because at some point we're going to see countries that do produce oil, whether in the OPEC or not, trying to cut back on their own production to keep their budgets in line.
Well, Carl, you mentioned OPEC. Of course, Saudi Arabia has been the resisting force in reducing the output. And some say that is to disincentivize U.S. shale producers. And that may very well be the case because some of them may have to close down if this continues. What's your thought on that?
Well, it's really a fine line. I don't know if Saudi Arabia really had the U.S. in mind because of this. I'd like to think that it was probably because of other countries in OPEC. They were kind of overstepping their bounds. A country like Iraq was really producing high and selling a lot lower than OPEC prices for a while there. I think they're just trying to keep the pecking order in order right now. So when it comes to U.S. though, it's hard to see the U.S. production slow down, especially since commodity prices are so high elsewhere. It's still a lot more expensive to import crude oil into the U.S. than it is to produce it here. So it's really a fine line.
But Carl, overall, are these lower oil prices good for the U.S. economy and for the U.S. consumer sentiment?
Well, there's a balancing act here. I think that oil prices at around $70 in the U.S. market or $75 really makes everybody happy. That keeps gas prices low, that keeps oil producers in business and making money, and keeps refiners going at a good margin. But, it's a matter of trying to get the rest of the world back up to speed.
But focusing back on the low gas prices here in the U.S., of course that means less profits for oil companies. At what point do you think that could become a problem in terms of them reducing hiring or laying people off?
We're getting there. Like I said, as oil flirts with $60 here in the U.S., the lower it goes, under $60, we're going to start seeing some action taken. Maybe we'll see less production, or for sure what we'll see is less future production. I think that we won't see as much money or time invested into future projects, and possibly cutting back on labor work here in the U.S. So I think under $60 is really that tipping point, and we're getting there very quickly right now.
Well, Carl, as we spoke about a little bit earlier, Saudi Arabia refusing to cut the output, and you said that was to keep Iraq in line. Now, there's a theory that with Russia wanting to push oil prices up, Venezuela, Nigeria, which are part of OPEC, needing that as well, that there could be an alternative oil cartel being formed. How likely is that?
I think that's very likely, Michelle. It's a very interesting point you bring up there, especially when you look at the Latin American countries. Venezuela right now is in a very, very bad position. I think that they cannot keep their budget in line with oil prices this low already, and it's only getting worse. So it's very possible they would be the first ones to break away from the OPEC and maybe form their own cartel down in Latin America. That would make a lot of sense, and it would probably have to happen soon.
Carl, very quickly, where do you see oil over the next 3 months?
I think that oil prices will rebound here. I think we'll see economies kind of stabilize and pick up. I think WTI in America will probably get to like $70, $75 soon within the next 3 months, and maybe Brent around that same area. I don't think Brent will be much higher than WTI in the near future, maybe at the same price or even lower.
All right, we're going to have to leave it there. As always, thank you so much, Carl Larry, Director of Oil and Gas with Frost & Sullivan.